Hey, good morning, everybody. Doc Severson with you here at Trade School here at ReadySetCrypto for today is the Friday, the 11th of October. I have to think about that for a second. So we're just flying through the year. We are into the final quarter of the year and waiting to see what's going to happen with the volatility here. So a lot of you continue with the questions on the options course. This is going to be a lifelong thing for you. I want to warn you ahead of time is like options are one of those things that you will forever be learning something about the statistical probabilities of how to measure markets through options and trying to get edge. And if you are able to master that, you will get significant edge in the option markets. And it allows you to not have to be right in terms of forward direction. You can still win trades without being 100% right in terms of your forecast, which is actually pretty cool. That's something that kind of took my attention away 15 years ago, and I've been pursuing that ever since that point. Okay, without further ado, let's get into the material. How's everybody doing out there? If you are live and everything is working, let me know. Otherwise, I'm going to assume that you're watching this through a replay later on. It could be later on today. It could be months from now. So welcome aboard either way. And of course, if you have any questions, if you're watching this on a replay, I invite you just to push out an email to us, support@ReadySetCrypto.com, and reference moi. All right, away we go. I'm down here in the lower left, and I will remain so unless I start getting in the way. Hey, Tig, what are you doing? It's one of those things. All right, let's get it out. Okay, no trades today. So today's topic is going to be option chain statistics, and I had a request to talk about some of the tools on skew.com, and I have some good news for you guys. I appreciate you guys bringing this to my attention. Okay, thank you, David. So, there is a wealth of forward-looking statistical information available to traders on the option chain. You may not... I've got something down there. Hang on a second here, guys. All right, option markets are efficient. That means that everything is priced in right now as we know it. There's no like the market waits to move until it hears the news. It's already moved. It's already priced in everything that it possibly knows about every forward event. And because of that, there are some very interesting advantages that we can pick from that. So every option in the market has its own market with supply and demand, right? So each put and call that's in the option chain on every series has got its own demand. You've seen the open interest and volume on each option that's out there. Each one of those, it's got its own little micro market to it. And if we look at these options, we can see what gets bid up and what gets, ignored and those kind of things. And because of that, we can sort of forward understand what people are, which way they're leaning, which is very, very interesting. So remember back in grade school, we talked about the normal distribution curve, right? So a lot of, this is called the old bell curve, right? So everybody talks about being in the meat of the bell curve in here in this area. Notice that plus minus one standard deviation is about 68.26%. And that's a number that we'll be referring to going forward, because those are staying within one standard deviation. If you're a math whiz, I'm sure you can correct me from leading everybody astray. But for right now, this is kind of what we're going to be focused on, is understanding what gives us one standard deviation of movement around that mean, right? So you can forward project the expected move that is priced into the option chain plus minus one standard deviation, which I think is actually pretty cool. And what you'll find is that more often than not, the price will kind of adhere to that. And if you're talking about something huge like the equity markets, there's actually support and resistance which gets baked in right around those one standard deviation lines, believe it or not, just because everybody's watching those and everybody knows what the expected move is and kind of trades around the expected move. Now, I can't speak to that in terms of Bitcoin or Ethereum right now. It's more of a suggestion. And quite frankly, I don't know that anybody really knows the forward lean of the market right now. But again, we can pull this out from the option statistics. So I'm going to show you how to calculate this expected move and put it into play. So hopefully this is something that will be enormously useful for you. It's something that I use every day. So first of all, determine the option series that you care about in terms of time. An option series is going to be like the 25 October or maybe the 27 December, right? So it's a date. That's the expiration date, and that's what we call the series. Find the closest at the money call and put. So they're going to be the closest possible to the price. The granularity is not very good right now still on Bitcoin. About the best granularity that we get is about $500 versus the USD. On Ethereum, it's a little tighter than that, but on a percentage basis, it's about the same. So the granularity will probably increase over time. And what you'll notice is as an option series gets closer and closer to expiration, they tend to backfill in with more of the strike prices in there. So they do increase the granularity because there's more opportunity, and that you're also vectoring in on the price of where it's going to expire. So find the closest at the money call and put at the same strike price. Determine the at the money straddle price. A straddle is where you buy a put and a call, buy a put and a call at the same time. Now, I know you can't do this in like Deribit or Ledger X. You're going to have to synthetically put it together. You're going to have to buy a put and then go out and buy a call. As the markets mature, we'll get into better interfaces that will allow complex orders. But in the equity markets, this is quite simple to do. You can just put in an order for a straddle. And straddle is, think about you're straddling the price with a put and a call. So it kind of makes sense. And this is where we start to get into all these colorful, creative names that are part of option strategies. We have crazy ones like the Iron Condor with the wide wings, right? We've got the butterfly, which is centered around a specific strike price. We have calendar spreads. We have debit spreads, credit spreads. We have all kinds of wild sounding strategies. Unfortunately, it's very difficult to do these right now in the options market within crypto, just because the granularity, not so good. Liquidity is a little bit questionable still. Well, it's not questionable. It's still very light. And it's just difficult to do with the interface. But this is something that you'll grow into, the market will grow into. You can certainly take these principles and apply them to the equity market tomorrow as well too. So these are all concepts that we learned from the equities market. We're just transferring over to Bitcoin. So you can do the opposite and the other way around. All right, so the straddle price will reflect approximately plus minus one standard deviation expected move. How about that? Now, it's a really rough calculation. There's ways that you can clean it up a little bit. So a slightly more accurate way is to add the at the money straddle to the first out of the money strangle. So the way that this is done, let's say that this is 8K here. Let's say this is 8K. And I'll try to draw this. So you've got puts over here, you've got calls over here, and let's say this is 7K, and this is 9K. So let me show you how this is done. So these are the different strike prices. So what you're going to do is the straddle is you're going to go long on these, on both that. Okay, so that's the straddle price. And then what you're going to do is you're going to go the first out of the money strangle. And so what you're going to do is you're going to buy a $7,000 put, and you're going to buy a $9,000 call. So this is the strangle, another great name, and this is the straddle. So what you're going to do is this one's going to be less expensive This one's going to be more expensive, and you're going to just take the average of the two. A lot of times, if you just take the at-the-money straddle, it's going to be good enough for what we want to do. So that's the difference between, this is a strangle out here, think out of the money strangle. This is a straddle where you're straddling like the railroad ties. So you now know the range that the price is likely to trade within a 68.2% probability of success. So right off the bat, you can say with a 68% confidence that, you know what, from here until expiration, the price should trade within this range and should finish within that range. It can trade outside of the range during that time. The probability doesn't say anything about that. There's other statistics which are part of other proprietary brokers that call the probability of touching, like a strike or something like that, which is important for something like a short put or a short call. But for right now, we're just talking about a range. So between now and expiration, the price is likely to trade within this range and expire there. So let's see how we do this. This is from this morning on Deribit. So I took the 25 October series. The price of Bitcoin at this time was 83.26, right? So the closest strike price that I can find is about the 8,500. So 8,500 is about at the money. It's the closest we're going to get to at the money. Okay, so the expected move is going to be, here's the bid, here's the ask. On the calls, here's the bid and the ask of the puts. So I'm going to go for the midpoint of this and the midpoint of this. That's where these strange numbers come from. So I'm assuming that the midpoint on the calls is going to be about 351. And then the midpoint on the puts is going to be about 526. And if we add those two together, that's the straddle price. There we go. $877. So between now and 25 October, as of this morning, we have about an $877 range. So there's a 68.2% probability that the price will be inside that range by 25 October. How about that? So let's see what we can do with that. The way that this looks, and what I've done is I've drawn a little probability cone here. So here is the expiration date. Here is the price this morning. So it could go as high as like 9,200, and it could go as low as about 74.49. So remember this slide. Go forward a couple weeks, so 2 weeks from now, maybe what I'll do is I'll come back to this slide, I'll bring it out on a trade school and say, hey, how'd we do? So if I forget about that, somebody remind me and I'll go back and dig this, I'll do some archaeology and dig this slide out and bring it back up and we can see how it did. Now there's no guarantee that it's going to be within this range. All there is, based on what we know today, is that the price will end in this range, inside this little arc, with a 68.2% probability of 7,400 to 9,203. Let's do another one, just like the other one. Okay, so expected move for 27 December. What should we expect here for 27 December? We're going 2 months further out. What would you think we would expect? First of all, notice that the puts and the calls are more expensive. Why is that? There's more time value in them. So the puts and the calls are more expensive. So the calls, I believe, are, now notice also that we're changing the strike a little bit. 8,300 is going to be closest to 8,000. So that's the best that we can do. What did I say about granularity? Far out, it's pretty wide. Closer into expiration, you get more granularity as the price becomes more obvious as to where it's going to finish. So 1417 calls, which is in the midpoint in here, and then the puts is somewhere in this area, about 1014 or so. That gives us an expected move of $2,400 plus minus $2,400 by the end of the year. Okay, interesting. You know, so for those of you that are out there, hey Doc, where's the price going to be by the end of the year? I don't know. Let's look at the options market. Let's see what the options market has to say. Well, it's going to be somewhere in this range, plus minus $2,400. This is not some kind of like dart toss, like, you know, John McAfee type of, you know, wager kind of thing. Like, well, I think it's going to be $50,000. It's going to be $1 million by next year. These guys, I don't know where they're getting those numbers from. Who knows? But this is something that's actually mathematical, right? This is statistical based on what's baked into the option chain, based on actual trading volume. So I tend to give a lot more weight to something like this, where we see the expected move. We're seeing the actual activity of the participants in this market. And they're telling us what they think the market's going to be in terms of the range. So plus minus $2,400 by the end of the year. Okay. That's more interesting. So let's see what this looks like. Whoa, it's a much bigger cone. Look at the size of that cone. Why is that? Well, there's more time. There's more time that the price can move around, isn't there? More time that it can move around. So what we're seeing is we have a range of 5,900 all the way up to almost 1,100 by the end of the year. A little bit more statistical, a lot less emotional. So let's think about how we can use this. Let's think about how we can use this. And I have a plant out there. How can you use this information? Let's talk about the applications. First of all, there's a better understanding of the market's view, not your view, not some emotional like, oh, I think it's going to go up to 20,000. Who knows, right? Now you're looking at the market. The market's telling you what to do instead. It's a more consistent manner of placing trades. So you can actually place the trade. You can say, well, you know, I'd like to have a probability of about 68% on this trade. I'd like to place my short puts at a 1 standard deviation point. So I know traders that do like credit spreads, and they say, I'm going to place them one standard deviation out of the money. And that's what they do. They do the same thing every time. And as long as they have a little bit of edge, they can actually win more than 68% of the time. So it allows you to be more mechanical, since the numbers are based on probability, or you're not basing it on some kind of unknown fudge factor or anything like that. So I think the magic here is I use these techniques, and this is where you get into the religious arguments. If you think the religion is bad in crypto, like, you know, the Ripple Army versus those that think that, you know, Stellar Lumens is the next big thing versus Ethereum versus the Bitcoin maximalists, it gets so tiresome listening to all the arguments. Like, who knows, guys? You know, I just don't see any arguments like that are happening in the equities market. Amazon is way better than Google, dude. No, nobody cares. It's just an asset. It's just a stock. Who cares what is behind it? You know, pick your own poison. You know, it's kind of like the old Apple versus IBM kind of thing. You know, so what? But what you can do here is you can actually combine the techniques. So a lot of times what you'll find is the statistical traders, these are the random walkers. So if you've never heard of a dude by the name of Burton Malkiel, he believes that there's absolutely no patterns within the market, any market. It's just complete random noise. And, you know, so you can believe that or not believe that, right? So he believes that are just complete random noise. So people that buy into that Kool-Aid love being statistical traders. They're just going to, every month, they're just going to put the same type of trade on, and they're just going to, who knows what's going to happen in the future. I'm just going to place the same kind of trade. Boom, 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 boom. Right? Because they're statistical traders. They're just going to let the market figure it out. That's one way to do it, and I'm not saying that's wrong or wrong. However, the other hand is those that are technical traders, those that are looking for some type of edge. Range contraction leads to range expansion, et cetera, overbought, oversold, whichever way that you view the market. And, again, if you do have some type of edge in terms of reading the market, that's going to work maybe 80% of the time. There's going to be 20% of the time, maybe 10% of the time, that the price just is going to do whatever the hell it wants to do, and there's nothing that you can do to predict that. It just doesn't fit into any model when you have a 3 standard deviation move, which comes out of nowhere. Well, what can you do with that, right? So nobody predicts the market accurately. It's more of just looking at potential forward movement based on what it's done in the past. So that by itself has got limitations. But if you put the two together, I think this is where it can really yield some benefits, right? Because if you do something like, what I love to do is I love when markets are super quiet, and when you have a super quiet market, what would you imagine is the forward expected move? Tiny, minuscule, right? If you have a super volatile, unvolatile market, you have very, very small forward expected moves. Market's not expecting anything because nobody is expecting anything. And then all of a sudden, range contraction goes, boom, range expansion. That's a huge edge. So if you can identify those edges where you get everybody leaning in the wrong direction, on a volatility perspective, this can provide some dramatic edge for you. Something else that you can do is, and you'll see me do this with selling puts, right? You see a market just screaming down like this, and everybody's like, whoa, I'm not touching that. And I'll dive right in, because over time what I've learned is that's a huge edge, because the forward volatility is now enormous. And what that means is that the options have blown up like this. They're just huge and wide and just full of time premium. And that's when I will step in and sell, precisely when it feels suicidal to do that. Now, can I find that from a statistical edge? Yeah. And this also is where it lines up with the technicals, because the technicals may say, okay, it's at exhaustion, it's down at support, I've got massive forward expected move, this is the time to sell. Not the other time when things are quiet. This is when people get run over. Okay, so before I go any further, I'll just pause here for a minute, see if there's any questions relating to expected moves, understanding how to identify those from the option chain, how you can use them. Right, so this is not the be-all, end-all. This is kind of like an introduction to expected moves and how to use statistics from the option chain. And I would probably guess that a lot of people are out there right now like, hell, I didn't know you could do that. So if you have any questions, let me know right now. Tig, if Burton Malkiel believes the market is random, does that mean his method is based on money management and cut your losers and let your winners run? I don't, I've got his book up in I bought it used because it's like, I felt like I should read it. But I don't know what his specific methodology is. I don't know what his methodology is. Now, the people that do believe in random walk, the statistical traders, what they generally do is they will generally do the same thing over and over and over again. They'll look for volatility edges. They'll look for time value decay edges. They'll look for little edges in ways that, perhaps are not that easy to find. And volatility, a lot of people will trade based on volatility. So they'll look to sell high, buy low, or they'll buy low and look to sell high. So a lot of them are playing the volatility game. That's the great thing with options is like, you can not really care what's going on with the price. You can just look at volatility and just trade that. There's many, many professional traders that just do that. They're volatility traders, or Vega traders, if you want to call them that. there's a whole notion of traders that are just around time value decay, right? So they're just option sellers, and they just do the same thing again and again. And what they do is they actively hedge their positions. They use the delta, they use the Greeks to actively hedge their positions, and they create this sort of blob. So they'll start out with an initial position, and if the price doesn't go anywhere at all, they just leave it alone and collect their profits and blow out of it. But if it starts to move, then they have limits, and they say, okay, I don't know where it's going to move. All I care about is the Greeks, and I'm just going to manage it within my risk parameters on the Greeks. So again, getting back to your question, I don't know how Burton does it, but I know the people that buy into the whole random walk thing. It depends on what type of trader that they are in terms of what they believe. Of course, risk management is always key towards everything. Money management is always very key. Staying within your risk parameters, not allowing one trade to completely blow you up is very, very important. Okay, any other thing? Generally, if we're talking about options, it's very, very much not about letting winners run, because typically what you're doing is you're selling something, and you're just managing your pile, and you're trying to massage that pile of inventory into a profitable state. So typically we're talking about lower returns for something like this, where you're making 3-4% a month kind of thing, and you just do the same thing month after month after month, right? You're not looking for home run trades. All right, let's move on. And if there's any other questions that you guys think of by the end of today's session, I will do that. So skew.com, and I forget who was asking, maybe it was Dom was asking about skew.com. So I looked into this, because I'm not out there looking for tools all the time. I've sort of gotten used to being a minimalist when it comes to trading options. It doesn't really require me a whole lot to come up with edge for options, just because you do it long enough and it's simple, right? You're just looking to sell into the fear, look for a bounce, take the position off, manage inventory, manage risk, identify your exits before you enter them, that kind of thing. It's just simple. So you guys will come up with different tools and different, you guys have your ears out there looking for different ways to trade stuff, and that's awesome. So he brought up to me skew.com, and I'm like, oh, okay, there's a lot here. So this is free, at least for now, until they get a bunch of people on there and start to charge for it. But I looked into this, and look at this, with Bitcoin options, there's a ton of stuff on here, and we can bring this up on another screen and look at this live. But one of the things that stuck out to me right off the bat was at the money implied volatility. All right, this is big time. This is a big win for us, because this is something I've been griping about for the last couple of months, is that Deribit will give you a nice graph of historical volatility, but they won't graph the implied volatility. So how do we know when something is relatively high or relatively low? I talked about this a couple of weeks ago in one of the previous trade schools. I showed you guys what I do in Thinkorswim to understand whether something's on a percentile basis. Hey, this is 80 percentile implied volatility. It's really relatively high. Or this is 5% implied volatility percentile on a scale of 0 to 100. This is really, really low, and it's more likely to revert to the mean, back to high, those kind of things. So this is a lot of what we do in options, is understand whether something's relatively high or relatively low, and then adjust accordingly. Find edge based on that. So if we just look at this one, this is a big win, I think, because you can see here that, so we have blue is 1 month, red is 3 months, and then green is 6 months. So these are implied volatility. So somebody's actually charting these, or they're scraping these off the implied volatility chain for whatever broker that they're using, more than likely Deribit. And they're graphing these. And so what we're looking at is, we had some relatively low implied volatility And I think this is really interesting too, where notice that somebody knows something here. Look at this. Somebody knows something here because the implied volatility started to really sneak up before we had that big event, before we blew to the downside, right? So somebody knew something, didn't they? Because what started happening is the implied volatility started going up and up and up. And why would something go up on the at-the-money options? Because people were buying straddles. More and more people were buying straddles. So what's happening is if the implied volatility is going up, that means those options at the money were getting bid up. Up, 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 up. And if that's happening, more than likely they're buying straddles, looking for a big move. So this is one way that we can look at things like the implied volatility graph. And in the equity markets, we have what's called the volatility index. We have a volatility index, or the VIX, which is specific to the S&P 500, which is nice, right? Although it's gotten a little bit bastardized lately, but this is important because it's showing a leading signal. It's showing a leading signal. Right now we see nothing, right? There's really nothing going on here, and it's actually very low right now as we sort of saunter into a range. But you can clearly see these excuse me, spikes that occur. And this is where we have relatively high implied volatility. Here's relatively high implied volatility. And now I could say this is relatively low implied volatility. So this is not a very good time to be selling something. I mean, from a statistical perspective, it's more than likely to revert back up to the mean. So the mean is sort of like in this area here, maybe 70, 75%. So we're actually below the mean to some degree. So what's likely to happen next is likely to revert back up to the mean. So this might be a good time to be buying something. So maybe even buying a straddle going forward. If you don't know which way it's going to go, and like we said, none of us know which way it's going to go. So this is a big win to have this implied volatility graph. So this is one of the things that you should look at when it comes to skew. So sell options into relative spikes in implied volatility. You can compare the implied versus realized. So you'll see stuff like you'll see like implied spike up on a move, and then you'll see realized, kind of follow it. And then here's an area where there's a lot of edge usually in something like this, where this will revert back to the mean, and then the realized volatility will follow it. So implied is always going to be a leading signal. Realized usually, like once you see a market go like that, it's usually going to move around quite a bit until it's like throwing a pebble into a still pond. You're going to get ripples bouncing around in there for the better part of half an hour after you do something like that before it goes totally quiet again. Because once you introduce energy into a market, it takes a while for that to come out. So, but implied will always spike initially on there and then come in quicker than realized will. So again, a big edge to the sellers, big edge to the sellers. And then of course, when we have very low implied, this is a big edge to the buyers, because at some point, if it's relatively low, we'll see some spike again. That's always the game. All right, so this gives you an idea whether IV is relatively high or relatively low. It's very dangerous to sell puts in low relative IV. It's very dangerous. So it was dangerous to sell puts back here. It was dangerous to sell puts back here, and this is why we didn't do any of it in late September. Some people did. They got impatient and they were like, oh, 9,000 should hold as support. Well, it should have, until we invented the quadruple bottom, which doesn't exist. And this is why you avoid situations like that. It's a trap for the retail. Okay, let me do this. I'm just going to bring down if I can, just going to bring this down. I'm just going to look around here for a little bit and see if there's anything else. So you can, there's just a ton of information on here. Like there's also Bitcoin futures. You can look at the different open interest on these. So Bitcoin options, I probably shouldn't have done that because now it has to redraw everything from scratch. But you can see the realized volatility. You can compare that versus the implied volatility. Realized is the actual price volatility. Implied is what's in the options. Implied means it's a forward look at the volatility. You can see the volatility term structure, the volatility's term structure. Implied volatility is always higher on the backdated options because, of course, you don't know that's much more time risk on there. So the implied volatility has got to be higher. The time premium in those options is much, much higher. Okay, so some of the other ones that we can look at. Now these are called the volatility smiles. The volatility smiles, and what this is showing is the out of the money puts down here are really getting bid up, right? Why would out of the money puts be more expensive? It's because people buy them as insurance. And the further out that you go, the more you see this. Now, fewer people are actually doing this out to March. Nobody's really hedging that much out into March, but they're realistically hedging for the next couple of months into the end of December. This is why the puts are being so expensively bid up. So this is very common. This is called the volatility skew or the volatility smile diagram. Okay, so this also does help you in a way because, yeah, it's expensive for those puts. It's expensive to buy out of the money puts as a portfolio hedge. You know, you'd think something that's like way out of the money should be cheap, and in some cases they are, but you're on a relative basis, you're paying a lot for them. But what's good is that you can sell this. Don't forget, you can sell this. You're selling those options, so you're selling more premium down there. So there's a slight edge to that. So there's all kinds of information on these things that you can look at. Somebody was asking like the put call ratio. Generally what you're looking for is like, here was a spike here in buying puts, and that was on the 28th of September. The 28th of September. So let's see the 28th of September. Let's see when that was. 28th of September was right there. So the 28th of September was right here. This is where people were buying the most put options. Not up here, but down here. And I see this all the time. People wait until the move and then they get scared and then they start to hedge. And what happened to the implied volatility after this move? It went like that. So once again, your instincts will work against you. In every market, I don't care what market it is, but your instincts will work against you. Your humanity that you're baked in, your DNA, is that of a terrible trader. Everybody sucks as a trader to begin with if you're just going to think about a human being. The time to hedge is here. We talked about this last week. I said, play defense during times of peace and not war. Here's a time of war, right? You got big time volume. You got huge implied volatility, and now you're going to buy puts? Bad mistake. Bad mistake. That's an instant losing trade. And right now, those things are underwater like you couldn't believe. Buy puts when things are quiet, when it seems ridiculous to do so. All right, let's see if there's anything else in here. Any other questions? I'm just about done here, guys. So that's the put call ratio. Okay, there's a lot of stuff in here which could be interesting, could be important. I'd have to spend some time to look at this. But that's a lot of what's on SKU. There's a lot of information on SKU. So I invite you guys to check it out. It's free for now. I don't know what kind of request an account, professional market participants. Okay. Don't know what this means. So if there's any other, the humanity. Yeah, we come from the factory completely programmed 180 degrees out of phase to be good traders. We really do. Human beings are terrible risk managers because we're irrational. We are irrational because we respond to fear in a very harmful way. And it's very difficult. It's programmed into our DNA, you know, like you guys have heard of the fight or flight reflex, right? You know, somebody gets in your face, either you want to punch them or you want to run away. You know, the same thing happens with a market attack. You know, we're not able to think clearly when the market starts moving around. So you gotta acknowledge that, and you gotta work around it. It's been a lifelong struggle for me. There's no doubt of that. Okay, guys, I am finito here. So thanks for hanging out with me here today. Trade School, if anything hits you on the way home, like, oh, I wish I'd asked him that, go ahead and shoot me a note. Or if you're watching this on the replay, please don't be shy about engaging. Just support at ReadySetCrypto. Drop us a line. Otherwise, you guys have a great weekend. I will see you on the flip side. See you around, guys.